Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, Phil Tarrant here, host of the Smart Property Investment Show. Thanks for joining us today. Kind of a bit of fun. I've got someone in the studio who I know quite well. When he starts talking, his voice may sound familiar. He was on the show a couple of weeks ago and he was chatting to me about depreciation and how the changes made in last year's budget has changed the ways us as property investors can look to maximise our investments through depreciation. Go and tune in if that's your bent and you're obsessive and you like to know every single dollar and cent in your portfolio and how it's working for you. I do recommend you go and tune in. We went through some pretty complicated issues and concerns around depreciation, how you should be keeping it top of mind. Me, for one, I got a valuable lesson out of it, and I've moved it up my priority list of stuff I should be thinking about, as I spoke about in that particular podcast. It's normally a bit of an afterthought for me, and much to the chagrin of my accountant who beats me up about it often. So it's now sort of a key priority to make sure that, as amongst a whole bunch of different moving parts of my portfolio, I want to make sure that my cash flow is as good as possible. So I've got a heightened approach on depreciation. But while he was in the studio, I persuaded him to make an appointment with me to come back and talk about his portfolio. And often it's pretty hard to get this sort of information out of. He keeps his cards pretty close to his chest. And it's my job today to make sure that I can try and get some key details about this guy's journey as a property investor. Brad Beer, CEO, BMT Tax Depreciation. How are you going?
Fantastic, Phil. Great to be here.
I see you're ready taking your jacket off, so you're ready to sort of get naked here and unveil everything about this journey as a property investor. So this is not you as a guy who does depreciation schedules for Australian investors. This is about you, Brad Beer, property investor. Are you okay to talk about this?
Well, let's talk about a bit of that. I've had a very interesting journey and managed to, through my time at BMT, learn a lot from a lot of different people about property investing, because I come along as a speaker about depreciation schedules to just about every seminar in the country. Well, not everyone, but so many of them across so many spaces. And you learn a little bit, you listen a little bit, you formulate your own, you learn more, and you go to another one and get G'd up to buy the next investment property. And I sit there starting to assess my own stuff when I go to these. So let's talk a little bit about that journey. Absolutely.
Well, that's good, because I'm a very self-reflected investor, and I took your message loud and clear. And you didn't say it in so many words, but it was more about, Phil, mate, you got to concentrate a little bit more on your depreciation stuff. So I'm always looking to improve as an investor. So it's important. And I like you, I get a great apprenticeship in property investment because we have different stories. I talk to people about investing. You see inside everyone's portfolio because you're doing their depreciation schedules. But we can all learn. You're I would say on the scale of investing, you're a sophisticated investor. I know you've got a pretty reasonably large portfolio. I'm not going to go into details on it, but
I'm pretty busy.
You're pretty busy, and I know you've got lots of stuff going in lots of different areas, and you've evolved from just buying meat and potatoes type properties to doing some development and stuff. So let's start back at the very beginning. Your first property. What was it? Where was it? And have you still got it?
2002, okay. I purchased it. So I started with BMT, still at uni in 97, and saved up in my what was then 98. So, only 4 years in, what was then my part-time work that turned into full-time work pretty quickly, and saved up. I had no backing, no money given to me to make it happen, and didn't really know that much. I had an interest, but then I started doing depreciation. I started learning and listening and hearing how to make money out of these things. So 2002, and it was probably a push from my... that was the same year I became a shareholder in BMT and a director. And it was probably my partners pushing me as well. They were doing it already and buying property. It's a 4-bedroom house in a suburb called Georgetown in Newcastle. Okay. My partners had actually looked at it, had this great big shed out the back, which I had. So I still have the property, and I think I love the shed the most, almost.
So you're a Newcastle boy, born and bred, right?
Taree, actually.
Okay,
I grew up a little bit further up, moved to
yeah.
Newcastle to uni, and then had to move to Sydney part for work, and still seem to float between those of the world and the rest of the country around this business because we're national. But yeah, so I bought this really old, bad condition 4-bedroom house with the old forever boards on it. When I pulled up the carpet, it had newspapers from like 1914 or 1910. So I bought it. I went in straight away and started renovating. I was up at midnight, pulling bathrooms out and doing all sorts of things. But it was $170,000, and about 5 or 6 months later, I managed to get a drive-by valuation after renovating inside. I don't know how they do those when I only renovated inside, of $240,000. And it was the first leapfrog bit of equity. It was all pretty tight. There was a few things probably put on the credit card in that renovation, and a lot of work done by myself, my mates, and etc. Through that period. And that leapfrogged me in the ability to buy a second one only 6 or 7 months later, I think it was, a little place in Mayfield that I paid, I think, $210,000 or $220,000
Mayfield
for.
up sort of Newcastle way again.
Mayfield's another suburb a few blocks away, and my bit of renovation done on that, and I did some myself and had some other help on that one. Still have that property. It's currently about to become vacant with about a $530 a week rental. I've done a bit of renovation then a fairly major one about 18 months ago where I sort of knocked a bit off the back, and I think its valuations at about 600 or 620, I think it was. And the first one at Georgetown, probably about 575, I think was the last time I got a valuation.
So Georgetown you bought for what'd you say?
$170,000.
170, now 600.
Now just under 600, I think is the latest valuation. Okay. And that's probably 18 months ago, so it's probably a 600K.
And Mayfield, what was the purchase price again?
220,000, I think it was. It might have been 210.
And now 500 something.
600 was the last valuation. Probably about 12 to 18 months ago. I did a few refinances then.
And that was late 90s that you...
No, 2003 and 2002 and early 2003.
You've done pretty well out of it.
Yeah, those have done well, and I think I then made a couple of mistakes and bought some land that I still have that's still vacant. On a surfing trip not far from home.
Yeah.
With me and my mate, thought we'd buy some land. That sounded like a great idea.
Are you talking like rural land or?
No, house block of land, but it's in an area that was sold and hasn't necessarily performed very well.
Okay.
I still have the land. I really probably only have it because it probably slowed me a little bit. It didn't stop me from other investment. And I was, build on them, etc., hold them as investment properties. But now they're not a major part of the portfolio. They're probably something you could unload. But because I don't have to, I haven't, I suppose. And it hasn't stopped me from doing other things.
So your first two purchases, is that more luck than really strategic identification of area you knew was going up in value, or a mixture of both, or it's time?
Look, I still, and I have a lot of my portfolio, and we can go through and talk about some other the suburbs that I've bought in over that next period of time. It was, I still have a fair bit of belief in that area, and it's had its slow times, and it's sort of mirrors Sydney a bit later sometimes, which is kind of good because it's almost a place that you can see a little bit of sometimes what happens. Would I say I knew the amount of drivers and things that drive property growth and value that I did back then now? I know more. I'd probably make different decisions. I knew the area a little bit better. I'd been there for a bit of time. I learned about the area. And the other thing was I needed to be able to grow equity by renovating.
Okay. So you're talking about manufacturing equity as a term.
Manufacturing some equity. I'd be then later always looking for the property that I could easily turn a 2-bedder into a 3-bedder, new kitchens, bathrooms and things that I could do some renovation, revalue, get my cash back out of that sort of so I could have the deposit for the next one. Otherwise, I couldn't keep going.
Yeah, okay. Subsequent to those first couple of purchases, a block of land that you purchased in the Newcastle area as well. When did you step outside into the big smoke, down to Sydney or go to Melbourne, or how long did it take before you started moving in other markets?
Not for quite a while.
Okay.
I was then buying, renovating, revaluing, and I'd do these things where I'd then actually push my finance pretty hard and get 95% lends. So it meant that I could get all of my cash back out to drive again. And the area was slow for a little while, but I kept buying and renovating and manufacturing. And it was probably not for another 5 years after doing a few of those that I managed to fall. And this was probably more fall across something in Melbourne through clients that was a distress necessary. So I just picked it up inexpensively. It was the first unit I bought. It's in St Kilda. I paid $360,000 for it. It was a fully furnished 2-year-old unit. I'd already had a $400,000 valuation, then a $550,000 not much longer. Haven't valued or touched that one for a while. I'm not sure on its current value, but it's always consistently rented for $500 to $550 a week since then. So it's been a thing that yielded quite well. Has it been my best growth property? Probably not if I had a punt on its value now, but it did spread that portfolio a little bit. It took me a while.
Never taken equity out of it?
I did once, I think, a few years later, but I haven't for 10 years now, effectively. So I generally am I've always been someone who likes to revalue and make sure my equity is liquid. I push it back to offset accounts, and so I think finance is a very important part of your portfolio. Firstly, being ready, but secondly, money on the way through gives you the control for the next deal. I don't need to ask the money I don't need to ask the bank for the money for deposits or for renovations or anything like that. I can make it very simple now, and it gives me more negotiating power when I want to do things that maybe the bank doesn't like, because maybe sometimes you don't need them.
So we'll touch on the financing in a sec, bro, because I'm really interested in how you go about balancing what is different lenders. When you start getting a big portfolio, as I speak about a lot, it turns into a big headache. But just take a step back quickly. You've spoken about the way in which you've gone about accumulating wealth through property. So you're buying properties, renovating, i.e. manufacturing equity, getting to a new valuation, pulling that increased equity out, going again, and just leapfrogging into each of these properties. And it sounds as though you're not selling too many of them, so you're holding on to these properties. What's the overall objective for you for investing in property? I know, like me, you like the game. You like being good at it. You like, playing it well and winning, and that's a good thing. But what's the real long-term strategy for you?
Wealth creation is the reason to get into property in the first place, and that hasn't changed. Yes, I've liked the game. I've liked the renovations, not doing them, but the deal that you buy, renovate, turn into a better value, you end up with a better property, and means that I use a bit of my cash and a lot of the bank's cash to actually leapfrog through leverage into a higher value of property, and with growth over time that's happened, providing I haven't bought in really bad areas. In another 10 years, the properties that I hold, most of them will grow again. And providing on the way through the cost to hold them is low, and I've been pretty careful on that from a cash flow perspective to make sure that it's something that supports itself or produces some cash flow. And then the growth through leverage at the other end of that is sort of the cream, where I make the wealth creation at a later date. Selling properties, I have sold one property in all the time, but it was one I owned in partners with people, and we all didn't need it into the future. And it was a commercial building. That was one commercial. I've only got one other commercial building which houses one of our offices. So, but the rest of it's all been residential property, and then moved into some development property at a later date.
So how would you articulate your strategy? Buy and hold, but that's pretty base, right? What is your strategy for property investment?
Buy, hold, control the cash on the way. Make sure it's something that's delivering to me my ability to make decisions. It's not something that makes me need to go to work to support just for the future, but could be supportive of me on the way through. At the end of the day, it's a play in producing. It's a wealth creation strategy for the future and for my family, rather than just being a buy, sell, go through quick gains. I think, in quick growth times, you can make some money quickly by changing. I think changing costs money all the time, and you're going to go back into property again. Then, make a good selection at the start, and the passive ability to make income out of those things into the future is quite attractive to me.
So do you have a deliberate strategy in that at a point in time when you choose to have a choice to retire, whatever that means for you, and it means it's something different for everyone else?
Phil.
You'd be bored. I'd be much the same. But do you intend to? So you're in this accumulation phase. So you're still building the asset size. At a point in time, will you retire down the debt, have an unencumbered portfolio, and when you choose to depart this great world, you'll give it to the kids and say, "Here you go. Here's an asset. Don't stuff it up."
Well, look, I'd like to make the challenge sometimes is how do I make sure that my children are 3, 2, and 10 weeks, so how do I impart the things to make them learn when they've actually got a base there that's been passed on, that they can use that the right way, and rather than hope they don't stuff it up, teach them the fundamentals about the importance of treating it properly is what my challenge is effectively. I don't see me being a sell a bunch at the retirement, whatever that means, phase necessarily, because I think maintaining the ownership of these properties gives me control of the ability to finance properties, and providing the learning is correct on the way through. It doesn't need a lot of selling, may need a bit of selling here and there to make sure it's exactly more sustainable than it could be, because for some reasons you've got properties that maybe don't fit in that as well. But even in building a few things, I've held them rather than selling them off when new is probably the premium time for your value, and has that bit of a slower period just afterwards, because it becomes secondhand, and there's another new one 2 years later that's close. But I've held them because I want to hold them longer term than just that short period of time.
So we've spoken about these initial few purchases, and it sounds like there's a few of those similar properties. So
I had renovations going
go.
3 at a time, like
which is a headache in itself, and maybe we should have a chat about it at some point. But when did you start? And I know in my portfolio, the more you buy, the more sophisticated you get, the more you think laterally about what you're doing. You start getting properties with X factors with them. So there's upside opportunities should you choose to capitalise on it, to knock down, rebuild, develop, granny flats, all this sort of stuff. How far through this journey did you start getting a little bit more ambitious with some developments, small scale developments, or more trickier stuff, I'll call it?
I'd say getting ambitious probably happened fairly early, but I think what I was fairly careful to do was to be a property investor and buy properties that worked as investments that had the ability to do something with them otherwise from a development perspective into the future. And look, I did buy with a partner 2 houses that had a DA attached for 12 units around the GFC time, but I bought them as 2 houses rather than a development site, and developers are forced to develop to continue, and we paid less for them, and unfortunate for the developers that did what they did, but they put the DA on there. Then the time wasn't right for developers, but the time was okay for property investors. So we bought them as property investments with an upside. We ended up changing that into buying some more land off some people attached to it and changing the DA, and still keep retaining some houses and doing some major renovations on houses and building the units. But the important thing was that, or other properties I bought since that had the ability to build another house in the rear. They were okay as property investments, but they had potential ability. And I wasn't buying them as a developer. I was buying them as someone who could develop them should I choose to, or I could DA and potentially sell to a developer. But I've DA and I've built some. I've got a couple more to build that I need to do something before the end of the month, or the prices will go up because my DA's nearly run out because I did them some of them some time ago. But I've never been forced to be a developer, which is a great position to be in because it gives you some control over whether or not you have to do it. So I did it early, but I didn't really ever go past that. In managing the risk of your property investing, how do I make sure I'm never forced by someone else to do something I don't want to do, including the market, effectively. And the simple residential properties that I still kind of believe in, the buy, build that bit of equity quickly, buy the right property, the right area type strategy. I'd still do those tomorrow. I'm just not out doing them at the moment necessarily because I'm been building and busy with a business instead, effectively.
Yeah. So when's it all gone wrong? Have you really stuffed up along the way? You dodged that?
Land is probably my biggest stuff up, but it's not a high value. It probably is worth more than when I bought it 13 years ago, but not much, and not by as much as I've paid an interest in owning it over that time. I definitely say I have properties that, hindsight's a wonderful thing, Phil, that haven't grown as well, so therefore I wouldn't have bought that one, but there's not major amounts of stuff up there. I probably went back around my hometown and bought a few that just didn't get the growth because it's just, and I probably use that as an example sometimes that sometimes the smaller country areas just don't get the growth because they don't have the drive and the push for people. They've been okay cash flow, etc. But if I compared them to others I've bought in larger areas like my Newcastle stuff, which a lot of my properties are at around the suburbs, they've performed a lot better without, and they maybe cost me a little bit more to hold, but they were manageable. And those ones maybe slowed me down a bit at certain times. I was pretty bullish for a long time in having a good solid crack at not being scared of having a crack, because I think, I started with nothing, and on the side of that, there's definitely times where I pushed it and had to push the finance to get through to make happen through those times. But the mistakes are probably some of those, and other than that, the things have performed fairly well throughout the time.
How would you explain your appetite to risk now? It's are you a bit more subdued in your older age? Not that you're old, but you're still giving it a crack.
I'm only 42.
Oh, you're young.
I just feel a little older all of a sudden. I feel.
Are you still giving it a red hot go, or you sort of you're not haven't got the throttle down as much?
I'm still willing to give things a red hot go. I also am not the put everything on the next deal guy.
Yeah.
Now, earlier in those days, everything on the next deal probably wasn't how bullish I was, but there wasn't much to start with. You know, I've got a few properties in the early couple of years that have grown in some value. There's some equity there, and I would be prepared to take a bit more risk. But I think the whole way through, because of finance, it's about managing that risk and not leaving yourself too close. And I'm probably bullish in different ways now, but I've also got a good equity base. And I think making sure I revalue, refinance and control the cash means that I make decisions before the bank does, ever.
That's what you need.
Even if it does get hard.
And what sort of diversity of lenders do you have?
I would have relationship managed between all of the big four with some debt. And I would have I would probably have about 7 lenders.
7 different lenders.
About 15 different property managers or 16 spread across different places. I've spread it between all the time, and I've moved it sometimes. I move it with whoever's giving me the appropriate deals at the time effectively. I try to be loyal where possible, but unfortunately our banks aren't very loyal. There's a new deal for the new guy that comes, and all the time, you know, low interest rate. I'm the guy that's already paying my interest. How come you keep offering it to someone else?
Don't start me on this. Don't mess up.
So spread well across, and I've moved them between. I'm always very careful that nothing's cross-collateralized.
Good.
I say that when I do have one that I had to in the early days, and it's one of those blocks of land, damn it.
Oh, really? Yeah. Are you fixing your interest?
I'm not a fixer. No? I've
play the market.
Yeah, and I've been, the only time I've ever kind of been burnt in interest rates was once when I fixed when they were going up and they all came down through a GFC, and I was paying 3% more or 2.5% more than everybody else. And I only fixed part of them, so not a major issue. But at the time, it covered some risk that I had with a portfolio that if it all went up to 10% or something, that could hurt me from a cash flow perspective. So it reduced my risk. So I'm not necessarily a fixer. And I think generally when you do the maths over time, a lot of the time fixing is quite similar, but that's because the bank understands the numbers as well, right?
Banks are a lot smarter than what you are. Then they've got a lot. They're boffins who sort out these actuary,
and it's a way
guys
to cover risk.
Yeah.
Fixing is a risk cover where it's like, my expenses from interest are not going to go and increase beyond this in the next 3 years if I fix it there. So if that buys you the time to be able to get through situations that might be hard or difficult, then I'm not against it either.
So we're running through a whole bunch of different scenarios here, what it means to be a property investor, and one question that we get a lot on this show is like, how do you hold these assets? So you've spoken about long-term wealth creation strategy potentially as an asset to pass on to your children. Do you hold these in a trust structure or the individual? How do you balance that out?
I've got them throughout multiple structures, but look, first one in my own name. I moved across the structures fairly quickly. Company trust structures, my wife holds some. The debts, some in my wife. As the director of BMT, the assets in my own name are minimal, which is the strategy that the accounting people have suggested. Not that I live and think that because it's not there that you shouldn't do the right thing, or that there's risk associated with business, and people in your business make mistakes. So you want to try to cover those risks as best as you possibly can. I didn't set up a self-managed super fund till the last few years because I haven't invested a whole lot of money into super, because I think they might change the rules before I get there, which they tend to do. But then in saying that, in recent years I have made some more contributions. I think my accountant fell off his chair when I made a contribution a few years ago. So I haven't bought in a self-managed super fund, but I do have separate structures for different properties that are company and trust structures.
And the question always is, why should you do one over another? And I get asked that same question all the time. And it's investing in trust structures is a little bit more complicated, a bit more of a headache, it's a bit more expensive. There's a lot of potential additional costs associated with it, i.e. in New South Wales you don't get any breaks on land tax if you invest in trusts. So what works for you won't work for other people. Once
you're past your land tax threshold, which
doesn't really matter. Yeah,
I get one, my wife gets one, and after that you pay. But I think it's an individual question, and it depends on your circumstances and your future circumstances, and the advice at the time based on people that understand that as best possible may be best for you as an investor. And that's different for different people, I believe. But look, the structures cost more, they're more complicated, and some people just don't need it. Depending on the type of earner you are.
Most people, from what I've seen, don't need it.
Well, most people don't need it. It's probably right.
Most people don't. So if you go back in time and grab a younger Brad Beer and grab him by the scruff of the neck and say, mate, don't do this, or mate, do this, what would it be?
I saved too much of my first deposit because I didn't want to pay mortgage insurance, I suppose. And then I became like very good at paying lots of mortgage insurance because it made me go quick. Now that's easy to say in hindsight, because at the time I bought, the market was moving quickly. And if I had bought 12 months earlier instead of saving, I would have made a lot more money. Now, if you're buying in an area and you think, and it's going to have that, and unfortunately none of us have the crystal ball, but that would be one of the major things, is if I knew a bit more about finance and wasn't scared of the things associated with finance like mortgage insurance, then I would have made some more money at that early stage and leapfrogged quicker. That, and just learning on how to control finance. Property is the vessel that makes the money, but the money is money, and finance is how you get there. And controlling of the risk associated with that, and then being able to sleep with those risks. Some people can't sleep with debt very well. I'm fine. But I wasn't when I was 20 years old. You know, I saved money to buy my first car and my second car and probably my third car. And then you realise that you've just got to actually learn how to use these things properly, as opposed to run away from that land while you're surfing and thinking it's such a great day and such a great spot. Would be something I'd grab myself on the scruff of the neck of. And most other things about portfolio would be the benefit of hindsight and growth would change. Look, I got a big land tax bill in New South Wales because I'm heavily weighted in New South Wales. I see land tax as one of the costs of owning an investment property. What it means is that for me versus someone buying their first investment property in New South Wales, I've got another, $50 a week in land tax I've got to pay, but it's one of the numbers.
And what's the jewel to the Brad Beer property investment portfolio crown? Is there anything which is like an absolute cracker that's going to do you really well in the future?
I've been a rentvestor up until only the last couple of years at 42. And the only reason I stopped rentvesting is because I couldn't find what I wanted to rent where I wanted to rent. And I guess the wealth created out of my portfolio allowed to help that to happen effectively. What's the jewel? I don't see one jewel. And the reason I talk about rentvesting there, and one thing was I was never attached to any of the properties. And I'm still not really attached to any of the properties because I could always negotiate hard. And even when I did buy a house, I still wasn't that attached to it. So I was always better at negotiating.
So you have a principal place of residence?
I do have a principal place of residence now, finally. And not until I was 40 odd.
Well, sometimes I'm still managing the whole. I hate the term rent investing, but I'm still holding out. So I'm still a renter.
Yeah, I started to do that because I had a property and living between places and a bit of Sydney time, a bit of Newcastle time, meant that what I did was found something that I wanted, where I wanted to be, that was worth a lot more money and got a really bad return. And so some other investor with a big tax deduction helped me to spend my time in somewhere beautiful near the beach instead of a crappy old house that I had to do up.
That makes a lot of sense. Good story, Brad. So you're going to keep at it? You're not slowing down?
The only slowing down has been around busyness and construction, really. I've got a couple to build, which I'll get underway pretty soon. Houses, on the rear of houses I've got another one or two to do after that. I might put something on that land if I redo the fees on it finally works once, or maybe I should flick it.
Is it far from the beach?
No, not far from the beach. It's near a lovely river and a lovely golf area, etc. But just,
Everyone needs
and I think
one of
the
them
end
in the
values are
portfolio.
actually pretty good there at the moment. So may look at that. But look, the thing is, if it's a screamer, I'm always open ears. When the market's flying, forget about it. I'm not going to fight with everybody else. I'm only here because I've got the backing to be able to get the deals done. I'm here for the screamer deal that needs someone who can't get the money, really.
Sounds familiar. And out of everyone other than yourself who's been integral to growing your portfolio, who's your number one A-team person? Who's your go-to guy or girl for helping you sort stuff out?
It's always been my co-workers that are in BMT, my business partners, past and present, that are living and breathing the game. They've either done it and been there. Most of the time, throughout the industry, the people I deal with all the time that are good clients, I talk to them about things because I get to learn, but not many of them would know much about my portfolio because I don't talk to them that much about it. Talk to them a little bit about areas and I learn and I see what's going on, but the deep my business partners and I've got business partners that I'm in property with. We're partners together. We look at that and we look at the numbers sometimes together, and we go off and do things.
Good, enjoyed. I think you've been very open and transparent about what you're doing, and lots of things that people can learn from. But I think what I take away from that is attitude is probably integral. So you got to back yourself. You don't sound like a procrastinator. So a lot of people are gonna do stuff. It sounds like, the 90% of winning is beginning, right? Is what they say. So, you got to give it a crack.
And right back to the start, there was a bit more procrastination than necessarily needed. But, sometimes, yes, do the proper research and learn. It's not have a crack without covering your risks and understanding, but don't be afraid to jump in. And keep having a crack and on the way through.
Yeah, wise counsel. I hope you learn from something from that. I certainly have. And I guess the bookend the chat, I got one of the best jobs in Australia in terms of property investment, where I get to speak to people who are doing what they're doing, and often I look to learn or emulate. And I think Brad has a story which I think every listener can really draw something from. So hope you enjoyed. If you've got any questions about it, email the team, editor@smartpropertyinvestment.com.au. I'll flick it over to Brad. You're cool.
Happy to talk about property. Yes.
Yeah. You do enjoy property, don't you?
I do.
Yeah. And if you tuned in beforehand, I think it was a couple of weeks ago when we had a chat with Brad, where we specifically spoke about tax depreciation. Get that on your agenda if it's not, and listen to that. And again, any questions, editor@smartpropertyinvestment.com.au. Brad, thanks, mate. Let's get you back in. I think I'd like to dig down into some of this development stuff that you're doing, because I know we sort of chatting off air that you do some pretty cool stuff. So see if I can uncover that as well. Remember to check out smartpropertyinvestment.com.au. If you're not subscribing to our daily morning market newsletter intelligence, first to know what's going on in property, smartpropertyinvestment.com.au/subscribe. If you get your stuff from social media, just search Smart Property HQ. You'll find us, like us, love us, and do all that sort of stuff. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.